Okay, we'll call the open session meeting to order. Good morning. My name is John Von Paris, and I am the chairman of the MDTA Finance Committee. I hereby call the meeting of the Finance Committee to order at 9 a.m. In accordance with the live streaming law, this meeting is being conducted via video conference and is being live streamed on the MDTA Finance Committee webpage. All members will have their video active during the entirety of the meeting. To minimize background noise during the call, I would ask that everyone on the line please mute your phones except when speaking. I ask that those who are presenting or answering a question to please turn your video and audio on when speaking. When you are done, please turn your video off and put your audio on mute. There are no members of the public, no elected officials, and no media who have pre-registered to comment at this morning's meeting. This time we will begin with agenda item number 1, the approval of the open meeting minutes from January 11th, 2024.
Motion to approve.
Okay, there's a motion, is there a second?
Second. Oh, sorry.
Okay, we have a motion and a second. All those in favor?
Aye.
Aye.
Opposed? Motion carries. Thank you. The minutes are approved. We will move on to agenda item number 2, the investment committee report. Quarterly update on the investment of MDTA's funds. Alan Garman and Clayton V are here to present. Good morning, gentlemen.
Good morning. This is Clayton V. I hope you can see me and hear me.
I apologize for for not pronouncing your name right.
Oh,
so,
that's fine.
Clayton V. I'll get that right.
No problem. Good morning, members. Well, if we move on to slide 2 here. Happily, this is a pretty consistent slide from quarter to quarter, and once again, we're pleased to report that there are no surprises in the portfolios for the period ending December 31, 2023. While all accounts continue to benefit from higher interest rates, those accounts invested for purposes of servicing outstanding bonds and principal, as well as capital spending, especially with the inverted yield curve, are doing notably well. The portfolio management strategies for the financial assets of the agency remain consistent, and the long-term reserve portfolios remain diversified in compliance with the mandated policy and guidelines. Moving on to the next market update, slide 3.
Are slides supposed to be shared? I don't see any.
No, they typically are not shared, Bruce.
Gotcha. Thank you.
That's correct, Natalie?
That is correct. The members have them in their materials.
Thank you. So on slide 3, with the seasonal slowdown in markets during the holiday period of the fourth quarter and extending into the new year, here the headline story has been interest rates, especially those prescribed by the Fed. And to the close of the calendar year, markets had prognosticated an easing of financial conditions via the Fed funds rate, and the yield curve declined in anticipation of the Fed easing interest rates. This has been coincident with the declining core PCE measure, as displayed on the graph on this slide. As you may see, the latest inflation print came in below 3%, and so speculation began with participants believing the Fed's work is complete with respect to inflation. However, in the past week, Chairman Powell has indicated the board needs to observe further confirmation that inflation prints, especially those for services, are not only declining, meaning disinflation trends, to more acceptable levels, but are sustainable at these lower levels. Moving on to slide 4. In fact, on the table at the top of slide 4, here we note the slowdown in core PCE inflation to 2.93% from a high of 5.55 in Q1 of 22. The Fed's target rate, as you may recall, is 2%, so Chairman Powell has reminded the markets that while progress has been made in this regard, the goal has not yet been achieved. Excuse me. An additional mandate of the Fed is full employment, and we know with the unemployment prints that this has remained surprisingly steady through this latest interest rate tightening cycle. This tightening cycle is demonstrated in the graph at the bottom, where we observe that the 2-year Treasury yield, for example, has increased from just above 0 to over 5% at its peak. Most interesting for current market participants is the expectation, again observed in the graph at the bottom of the slide, that interest rates need to, and perhaps have even begun their decline. Yet the anticipated decline is just this past week, again, pointing to comments from Fed Chairman Powell, has been pushed off or talked down, that board members need to see continued progress and further confidence that inflation is in check. What's also notable on the chart is that while during the course of 2023, there was some volatility in interest rates from the end of 2022 to the end of 2023 were almost the same. And we'll refer back to this point in the performance slide later in the presentation. Moving on to slide 5. This, as you may recall, highlights the diversification of the portfolios. Of note, in the past year or so, we've reduced the allocation to the agency sector, given some less compelling relative value. At the same time, we've been able to take advantage of very compelling opportunities in the municipal sector, and so that has increased. But that being said, during the fourth quarter of 2023 and into the new year here, new issue municipal bonds, and thus the opportunity to buy older issue municipal bonds as well, have decreased, notably in the general obligation taxable munis, where we are looking to take advantage of relative value opportunities. Moving on to slide 6, we show the maturity distribution for all of the agency's financial assets. In blue, you'll see we have the bond service accounts, match funding, which are bond service and capital monies, all less than almost all less than 1 year duration, with a small piece going out past 1 year. In the green bars, we show the long-term reserve monies and how they're invested out past 5 years. Are there any questions at this point? Moving on to slide 7 then, we focus in on the long-term reserve accounts, the general and the M&O reserve, and see that these are fairly well distributed across the maturity spectrum. We think in terms of another type of maturity known as duration, but this diversification by duration or by maturity exists regardless. Moving on to the compliance report on slide 8. As I mentioned earlier, we're happily able to report that the portfolios are all in compliance with the mandated policy and guidelines. There are no surprises. There have been no violations during the course of the quarter or the calendar year. And so that's why we'll see on the far right over there all the comments or feedback are positive. Yes, we are in compliance. Slide 9 continues this compliance report, and as again you may see, we are in compliance across the spectrum. Moving on to slide 10, on a quarterly basis, we do like to show the trade allocation by dealer. You'll note that at the bottom there, we were able to add Academy Securities late. Well, we received approval late last year, and then finally got all of the paperwork and documentation in place in early January. They were able to participate in one of the transactions we executed in early January, and that's positive, and we expect to see them competitively bidding for activity in the portfolios. So we appreciate your blessing and approval of their firm. Moving on to slide 11, we break down the portfolio again in a pie chart form by the match funding accounts. These would be bond service and capital primarily, as well as the total return on the left there, which are the M&O reserve and the general accounts. The shorter term match funded accounts are meant to match investments with projected spending patterns. And so we're not taking any real risk there as it relates to maturity or duration. On slide 12, Alan would like to go through the strategy just as a refresher for you.
Great, thank you. Yeah, as Clayton explained, we have two broad categories of strategies. One is a matched funding approach, and that's more or less prescribed by.
Hey, Alan, excuse me a second. Sure. There's some background. I don't know if everyone could check make sure they're on mute. Because I
muted somebody on the phone, so it should be taken care of.
I'm sorry to interrupt. I just want to thank you, Al. Apologize.
Thank you. I was trying my best. It's very distracting, so I appreciate it. So, with the matched funding approach, that's basically prescribed by our trust agreement and investment policy. And what that means is that the investment maturities for certain types of accounts should be matched to the known spending. And so in those accounts, our investment returns are very much a function of prevailing interest rates for short-term investments. So on the next slide, you'll see that, as interest rates have risen, those accounts have certainly benefited because most of the maturities are inside of 12 months. At times, the capital account can go out a bit longer than that, depending on how much cash we have on hand and that projected capital spending. For the bond service accounts, we set aside monies every month, and then principal and interest are paid out on January 1st and July 1st. So you would never see an investment maturity in those accounts longer than 12 months. And it's same as for our operating accounts, that those monies typically stay in overnight investments, money market mutual funds. The rest of the monies, which is a little bit less than half, are considered duration targeted. In the very beginning of this presentation, we repeat the same recommendation from the investment committee each quarter, which is that we're not trying to time interest rate moves, and we are recommending relatively stable benchmarks. So we're not changing benchmarks or changing strategies very frequently. So in the general account and the M&O reserve, that makes up our $400 million unrestricted position. That's a mandate in the board's debt policy. So that's the nature of those two accounts. They don't typically have any associated cash flows. There's not anticipated to be spending needs from those accounts. So that's why they're very stable, and we can take a bit more or accept a bit more interest rate or return volatility in exchange for higher expected annual returns. Clayton will cover the next slide, but the last point I really want to make is that this time last year when we were reporting on trailing 12-month performance, you'll recall that it was negative, and that was because of the large rate rise during that calendar year. And rates have more or less stabilized now at these much higher levels. And so, as you would expect, we no longer have that negative mark to market. And so that's helped the returns to be very positive. So I'll turn it back over to Clayton for the next slide, 13.
Thank you, Alan. So on slide 13, the portfolios investing in shorter maturities, notably the bond service and capital accounts, continue to do well and experience relatively lower volatility of returns. There we go. But again, these compelling returns, at least on a relative basis, have been notable to a large extent by the Fed's intervention at the front end of the yield curve via interest rate policies. The market's anticipation of lower interest rates on its face has impacted returns in fixed income markets as lower rates lead to price increases. As was mentioned in the earlier market update slide, during the course of 2023, that is to say, intra-year, there was some volatility in rates, yet rates from the end of 2022 to 2023 were almost the same. Thus, the returns for the year were driven by the portfolio yields. We have referred to this in prior meetings during our discussions, whereby one can expect the returns in the portfolios over the long term to equal the beginning yield, obviously absent any move in interest rates. For the 12-month period, the shorter maturity duration agency index return almost exactly equaled its yield at the end of 2022. The longer maturity duration strips index returned slightly better than the beginning yield, as there was a modest change in interest rates at that spot on the yield curve, the 7 to 10 year spot. Overall, it's a very good picture on an absolute and a relative basis. So in closing, the investment committee requests the finance committee's concurrence and recommendation to move to the full board for approval of the continuation of the investment strategy and the investment benchmarks. Thank you.
Thank you, Clayton and Alan. Okay. Are there any questions from board members? Okay. Member Ardinger?
Yes. First of all, Clayton and Alan, thank you as always. And I think I've brought this up before, and I just always want to just hear your assurances. In our brokers, we use Toyota Motor Credit, and I'm assuming that that's been tied into consumer debt, and we keep hearing that that's a potential area of concern. Any thoughts on that?
Clayton, do you want me to take that
Go
one?
ahead.
Or
Please go ahead.
I guess we have, in our investment policy, we are limited to the highest, essentially rated tier 1 corporate CP. And so that's somewhat born out of like a lot of analysis of corporate defaults historically. And so there was some comfort with an issuer that's rated that highly. So certainly I can appreciate, always the risks, I think, in the consumer market. There are always risks. We're hearing a lot more about commercial real estate and on banks. One of the elements of corporate CP that gives investors some comfort is, very historical low default probability because of the short-term nature of the debt is that, by the time an issuer starts to have trouble, your CP is typically maturing in, less than 180 days. We're often buying 90 to 100 days CP. So it's unusual historically for any type of entity, whether it's corporate or municipality, to go from essentially a AAA level down to default or below investment grade that quickly. So there's a little more comfort in buying corporate CP, whether it be, Exxon or Toyota Motor Credit. Not that things couldn't deteriorate for the issuer, but that we'd have some time for our securities to mature. So if we were buying like 10-year corporate bonds, and you're buying an issuer, you're making a fairly long commitment to its credit health. So hopefully that helps, is that we're a little more comfortable taking that corporate CP exposure because of the very short-term nature of the investments. And Toyota Motor Credit is still rated, tier 1. So that's the highest short-term rating from Moody's, S&P, and Fitch.
And if you may remember, back in the early 2000s with the corporate credit fraud, there was a point there where Tyco International, if you remember Dennis Kozlowski and his issues, but Tyco International was in the CP market. And what happened is that they let all the paper roll off, and the street would not allow them to refinance the short-term funding that they needed. And so, even had you wanted to, you couldn't buy it. It was just not available. So the market, in some sense, at least in the shorter term part of the corporate credit paper, governs issuers when they see there's trouble.
Sense.
Thank you, Member Artinger. Okay, any other questions at this point? All righty. Is there a motion to advance this item to the full board for further continuation of the investment strategy and benchmarks?
So moved.
Okay, is there a second?
A second.
All righty. Is there any further discussion? Okay. All those in favor?
Aye.
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 Opposed? The motion carries unanimously. Thank you, members. Clayton, thank you. Alan, thank you for your presentation this morning.
Thank you.
That is the last approval item on the agenda today. We will move on to item number 3, and we'll be talking, Jeffrey Brown will present the fiscal year 2025 preliminary operating budget. Good morning, Jeffrey.
Good morning. First, can everybody hear me?
Yes, I can.
Okay, sorry. So I was the offender before. I'm having technical issues with my camera. So I called in. I'm going to drop the phone right now. So if you can hear me, it should be good. Can you still hear me?
Yes.
Okay, good. Unfortunately, as I just said, I do not have a camera. I do not know what the issue is, having some technical difficulties, so you will not be able to see me, unfortunately. But I'm glad you can at least hear me. So moving on, I'm here today. For the record, my name is Jeffrey Brown, Budget Director for the MDTA. I'm here today to provide an update. If you recall, the last time we were in front of the board, actually, we got a contingent approval for fiscal 2025 operating budget. Is contingent based upon DBM fringe rates would typically get updated in December, which they have. So I'm here to provide an update of the impact of those DBM rate changes. And just for clarification, these are mandated changes that's handed down to us. So it's just kind of letting it run through to see what the effect is. So given the changes, the budget has decreased 0.7 million from 421.4 to 420.7 million. The detail by sub-object are employee retirement systems. The rates increased from 21.42 to 21.54%, which results in a 0.1 million increase. The law enforcement pension had a decrease in rates from 46.3 to 46%, which resulted in a decrease of 0.1 million. Workers' comp, this is an amount allocated to the MDTA, that decreased by 1.2 million. State paid telecommunications, the state radio invoice, that increased 0.3 million. Insurance coverage, which are the insurance payments made to the state treasurer's office, they increased 0.3 million. And then there's some sundry other changes, and they're laid out in detail in the table in figure 1. All those other changes account for 0.1 million. So again, in summary, we had a 0.7 million dollar increase. So our new budget for fiscal 2025 is at 420.7 million. I'd be happy to take any questions at this time.
Any questions?
So I have just one question related to the insurance. I know in a couple prior meetings ago, we had talked about evaluating our insurance premiums and looking for alternatives since the increases were high. And I know this may be referring to a different insurance policy, but I just wanted to see if there was an update on that analysis.
I don't, and I see Chantel's probably popping on, and you're right. The one that we're mentioning in this DBM is not the same major increase that we were talking about, which is the property and tunnel liability, but I'll let Chantel speak.
Good morning, everybody. For the record, Chantel Green. Yes, Jeff is correct in that we're talking about a different type of insurance coverage. But to answer your question directly, Member Rosen, we are looking at that. We actually have a meeting coming up within the next month or so. We're going to start talking to the insurance broker to see what we can do in terms of our insurance premiums going forward. So we're still continuing to stay on top of it.
Great, thanks, Chantel.
Thank you.
Okay. Thank you. Jeffrey, you're moving on to the next agenda item at this point. Are you good?
Yes, I am good. If there are no
Okay.
questions, I can move on.
Very good. Agenda item 4 is the second quarter budget comparison. Please continue. Thank you.
Okay, yes. So again, I'm here to provide an update now to the fiscal 2024 operating budget as of December year to date. As of December 31st, we had spent 39% of the budget compared to a target of 49%. Only Object 13 is over budget at 147% spend rate due to the higher insurance premiums. All other objects are at or below the targeted spending levels. The primary variance drivers are personnel vacancies, the higher insurance premiums due to the market pressures, and the seasonality of the expenses. By seasonality, I really mean a couple things. One is what's called true seasonality, which is, depending on what time of the year, you'll have more or heavier expenses, usually like in the third and fourth quarter for things like roadway maintenance and repairs and some engineering things of that nature. And also you'll just have some timing of when things come in, invoices and orders, especially stuff like IT where you'll have a one-time invoice for the year, and that occurs at various times in the year. So that can skew things and make it look like it's over under budget, but things are actually under control. It's just a matter of when the timing of the invoices come in. We've identified the risk associated with overspending, and at this point, we expect to fully offset any overspending with underspending in other categories, so we don't anticipate the need for any budget amendment at this time. Moving on to the detail, salaries and wages, Object 1 and 2 are at the budgeted levels with the 46 spend rate compared to a target of 49%. Communications is below budget at 21%, really driven by state paid telecommunications Object 305, which is a state radio invoice and which has not come in yet, kind of what I just described above. So that is expected to come back towards budget. Object 4 is at 33% spend rate. It's a little bit below budget, but we do expect additional pickup towards the third and fourth quarter. So at this point, we expect to be close to budget. Fuel and utilities is slightly below budget at 42%, so it's really close to budget. Motor vehicle operation, Object 7 is on budget again at 45%, but in detail, we have vehicle purchases are above budget with 71% spend, but again, this is due to when the payments and deliveries occur. We don't expect to be above budget. Vehicle gas and oil is below budget with 23% spend. Again, we anticipate higher gas prices as recently there's been some easing of the gas prices, which drives that variance. And all other major sub-objects are at or below budget within Object 7. Moving to Object 8, contractual services, we're at 25% spend. Looking into greater detail, advertising is at a 21% spend. Again, we do expect greater activity in the spring and summer as we have some public outreach programs expected. So this is expected to come back towards budget. The next 3, engineers, equipment repairs and maintenance, building repairs and maintenance, all are below budget. Engineers at 22%, equipment at 2%, and building and repairs at 22%. All kind of the same story. We do expect typically heavier activity in these objects in the third and fourth quarter with repairs of roadways, with additional or increased engineering work, things of that nature. So at this point, we do expect these to come back towards budget. Education and training is at 21%. Again, timing of activity, you have, a couple times a year where you have tuition reimbursement. Plus, we do have some expected programs in the third quarter. So we do expect an uptick in this spending. So it should be close to budget. Management studies is below budget with a 12% spend. Again, timing of activity, we've identified activities. So at this point, we're still expecting to be close to budget as that activity picks up. Security services really close to budget at 38%. And then the IT related objects, which I mentioned above, were below budget at 30%, but we really are expecting this to be on budget because we have major invoices that come in throughout the year And those have been tracking towards budget, so we expect this to be on budget. Easy Pass Service Center cost is under budget with a 21% spend. We are still continuing to monitor activity with this item, and we are working with the vendor on delayed invoicing, which has been driving some of this variance, and we do expect an invoice, I believe, this week. So we do expect as we work with this will come back closer to budget. Supplies and materials, Object 9 is below budget at 33%. Again, if you look at roadway maintenance and salt, both of those, well, roadway maintenance at 38% and salt's at 0%, but both of these are highly, again, seasonal, more activity in the third and fourth quarter, and especially with salt. Didn't have any activity until recently where we had a couple of snows, so I would expect that spending to increase. Uniforms is below budget at 30%, not way below, but again, it's just dependent when the deliveries come in. Transponders is below at 30% spend, but we are monitoring this, and we do expect some additional orders to occur, and we do expect another invoice to hit. So we do think this is coming back towards budget. Replacement equipment, Object 10 is at 16%. Again, both replacement maintenance building equipment, Object 1013 at 6%, and replacement computer equipment, 1033 at 2%. This is on dependent upon when we realize deliveries of equipment. So we do expect these to be back towards budget as well. Additional equipment is below budget at 12%. Again, awaiting delivery and payment on the equipment. Fixed costs is the one over budget at 147%. Again, this is the insurance, which we had mentioned before, at over budget at 173% spend rate, and that's the increase in premiums. As part of this review, we were asked to look at risks and opportunities. At this point, year-to-date, looking at those objects that are over budget at this point, and the overspending is $3.5 million, and again, that's primarily insurance premiums. We do expect to completely offset this overspending with underspending in other areas, so we don't expect the need for a budget amendment. Just for further information, we do maintain financial flexibility through any unexpected increases in the operating budget due to a function of its net revenue generation that we target to exceed 2 times annual debt service. So we do expect to be above that debt service, which gives us flexibility. And again, if we do happen to expect overspending to occur, we do have the ability to revise spending upward through a budget amendment. Again, as at this point, we don't expect to. And one of the things, or many of the things that we do to maintain our budget review or close to budget is we do review the variances like this meeting and ongoing throughout the year. And depending on what the variances are, we use that to refine future budgets and to quickly correct our financial forecasts so that we're providing the latest information. So any large budget item is both over or under spending. We review, determine, the causes, and then adjust accordingly. If that means, an additional budget required in the future or less budget required in the future, things of that nature, we use these variances and reviews to adjust accordingly. So that's comes to the end of my review. I'd be happy to take any questions at this time.
Thank you, Jeffrey. Any questions? Okay, thank you very much. Very thorough, and we always appreciate your efforts.
Thank you.
Okay, we will move on to the next agenda item. The second quarter budget comparison. Jennifer Stump is here to present. Hi, good morning, Jennifer.
Hi, good morning. For the record, I am Jennifer Stump, the Assistant Capital Program Manager. Today, I'm presenting the second quarter review of the fiscal year 2024 capital budget versus actual spending as outlined in the fiscal year 2024 to 2029 draft CTP. This information will also be presented to the full board on February 29th. As of December 30th, 2023, 22.7% of the fiscal year 24 $539.6 million budget was spent as compared to the targeted spending level of 50%. Actual spending through the second quarter was $122.6 million. 19 of the 83 projects budgeted in the fiscal year 2024 were within acceptable spending limits of 25 to 75%, plus or minus 25% of the 50% target. Due to normal lags in invoicing, a plus or minus 25% threshold is determined to be reasonable. In attachment A, it details 10 projects that were budgeted for more than 11 million each in fiscal year 2024. And actual spending through the second quarter on those 10 projects was 84.9 million. For risks and opportunities, we've had some procurement and contractor delays, MBE issues, and supply availability, which has impacted the fiscal year 2024 second quarter spend rate. As the weather improves, construction activity will increase in the third and fourth quarters. Projects that are beginning construction in the spring include the I-695 subgrade improvements at Bear Creek, Maryland 24 northbound auxiliary lane, which is Maryland 924 through the Singer Road intersection, resurfacing north and south of the Baltimore Harbor Tunnel, and an additional phase of work on the rehabilitation of the decks of the Bay Bridge on the eastbound span. This wraps up our quarterly update. Please let me know if there's any questions or concerns.
Just a question. I guess there are no, I guess a section on risk and opportunities. There's nothing to report on that area. Was that part of it, Chantel? Was that part of what the secretary wanted for each report?
Correct. Yeah. So that was when we were referencing about we've had some delays as far as our second quarter spend rate being low, but we expect that to ramp up as the weather improves in the third and fourth quarters.
Thank you. Are there any other questions from any of the members? Okay, Jennifer, thank you very much.
Thank you all.
Appreciate it. Thank you. Okay, we are moving on to the last agenda item, number 6. Here is it's an update, quarterly update on traffic and revenue. Cheryl Lewis is here. Good morning, Cheryl. How are you? I think you're on mute.
Sorry. Good morning.
Okay.
Thank you. For the record, my name is Cheryl Lewis. I'm the Revenue Director. And the purpose of this memo is to update the Finance Committee with quarterly and year-to-date actual and forecasted traffic and revenue performance. Some of the key takeaways are for the period ended December 31st, 2023, our total actual revenue, in-lane and administrative toll revenue, fell slightly below our forecast by $1.3 million. Easy Pass revenue exceeded the forecast due to higher than forecasted revenue. The administrative toll revenue and video toll collections were below forecast, mostly due to lower than anticipated revenue associated with MVA referrals. Let me see. Okay. I direct your attention to the table on page 2. You'll see that for the period of December 31st, 2023, transactions decreased by 4% or 3.1 million compared to the same period last year, while revenue decreased 2.2% or $800,000 compared to the same period last year. The variance is mainly due to the customer assistance plan, which took place in the second quarter of last year in November, and that resulted in an influx of video toll transaction payments that we didn't have this fiscal year. Okay. For the period ended December 31st, 2023, transactions or traffic exceeded our forecast by 1.9% or 1.6 million transactions, and revenue was below forecast at 3% or 0.3% or $1.3 million. The lower than forecasted revenue was mainly due to the timing of MVA referrals to CCU. This brought us below forecast by approximately $5.9 million. However, our Easy Pass revenue exceeded the forecast by $4.6 million, which cushioned that shortfall for the MBA referrals. So we ended with an overall $1.3 million below forecast. Any questions?
Yes, I do have a question. So if Easy Pass is higher, is that just because of total volume, or because more people are taking Easy Pass and therefore the tolls that we would have expected to collect are lower than what was projected, because that presumably those would have been cash tolls at a higher rate? Is there a correlation there?
Yeah, it's a correlation between more Easy Pass track usage, those who have Easy Pass, and increased Easy Pass accounts. Does that answer your question? Or
It does. So basically, yeah, so that's a good, it's great that more customers are using
Yes.
Easy Pass. We're collecting less in tolls, but of course it's also easier to collect as well.
Yes. Yeah, that's prepaid, so that's much better.
Great. Thank you, Cheryl.
Oh, you're welcome.
Artinger.
Good morning, Cheryl.
Mm-hmm.
When we reference referrals, is that tied in with the out-of-state collections?
No, that's to our in-state CCU.
Okay.
No, we haven't quite. Out of state is something that's being worked on, as far as you've probably heard of the RFP that's being worked on for out of state collections.
Okay. So can you just explain to me, when we're talking about referrals, exactly? I just want to make sure I completely understand what that means.
Well, operations ops, Easy Pass ops will make a referral to CCU for any outstanding tolls.
Okay.
And once they go through the MVA process and that process is complete, those tolls also get referred to CCU collections. And sometimes the timing, or oftentimes the timing, is a little off between collections and what we expect. So unfortunately, this quarter, the collections didn't quite line up with our expectations, and CCU is pretty slow, and the collection rate is pretty low there as well.
Okay. That makes sense. Okay. Thank you.
So hopefully ongoing we'll get we'll make up for that as we go along.
And Cheryl, member Artinger, if you don't mind, if I just sort of piggyback a little bit. So we have the MVA referral process, which is solely for Maryland residents, so we can't refer out of state folks the MVA for flagging and things of that nature. However, as Cheryl mentioned, we do refer after the MVA process for Maryland state customers. If we're unsuccessful at that level, then we will refer them to the state central collection unit. However, with out-of-state customers, because we don't have that MVA sort of intermediary, we immediately go ahead and refer them to our state central collection unit for collection. Thank you.
Okay. Is there anything else on this? Cheryl, you're good?
I'm good. Thank you.
All right. All righty. Well, thank you very much. Some very good questions
welcome.
asked. And thank you, Chantel, also for your comments. So thank you. We will, we have covered all the items on the agenda at this point, and that brings us to a motion to adjourn.
So moved.
Second. Is there a second?
Oh, I'm sorry.
Motion
Member
is-
Artinger, I'll second.
Okay, all those in favor?
Aye.
Aye.
Opposed? We stand adjourned. Sorry about that. I should have, I was a little